Hello everyone! My name is Jin. I'm a full-time mom and a property investor in the UK. I specialize in family lets in the northeast of England. In this video, I want to share with you how to be tax efficient in property investing while being in the UK. As property investors, we want to be serious about three types of tax: income tax, capital gains tax, and inheritance tax. Before we crack on with any of those, there are two important rules to be tax efficient in property investing, so please write them down. Number one, never sell your investment properties. And number two, as the property value goes up, increase the debt against it. Now, these two rules come about because of how taxes work in the UK, so you need to understand all three taxes to be tax efficient. I'll be explaining these in three separate videos, so make sure that you stay tuned to this three-part mini-series. Right, so let's look at inheritance tax. When you pass away, the first £325,000 that you pass on are tax-free. If you're a couple, then it's £650,000. To explain inheritance tax, we're going to take a look at Kim and Sam, who both own an investment portfolio of £1 million. In this example, we're going to assume that the residential home and other belongings has used up the inheritance tax allowance, which means that the only taxable item will be the property portfolio of £1 million, just to make it simple so that we can compare apples to apples. So let's look at Sam. Sam didn't like debt, and he paid off all his mortgage. He's been paying, for the past 40 years, extra income tax, which I covered in my last video. But what else happens to him? When he passes away, his £1 million portfolio has no debt against it. This means that his inheritors, like his kids, will have to pay 40% inheritance tax on the portfolio, which is £400,000 within the next 12 months. Now, unless John was a genius, he cannot predict when he dies. Let's assume that he dies when the property market is flat or falling. The kids are desperate to sell the houses in order to pay the inheritance tax. And they offer it to people like me who pay between 15 to 20% below market price, which amounts to £800,000. Minus the inheritance tax of £400,000, the kids are left with only £400,000 of the entire portfolio that they inherited. Now let's look at Kim. Kim knows the difference between good debt and bad debt. She also knows that as property goes up in value, she needs to increase the debt against it. Therefore, Kim has the same £1 million property portfolio as Sam, but she has good debt of £750,000 in that portfolio, and her equity is only £250,000. And that is what is going to be taxable, that £250,000. So when Kim passes away, her inheritors only need to pay 40% of that equity, which is equivalent to £100,000 of inheritance tax, rather than £400,000 that Sam's inheritors would pay for the £1 million portfolio. Would you rather your kids pay £400,000 or £100,000 in taxes? This is why you need to increase your debt when the value of the property goes up. I really hope you enjoyed this video or learned something new from it. If you are on the start of your property investment journey, or you have some money but no time or experience, please feel free to reach out and I'll be happy to see how I can help. With that, thank you for watching and see you in my next video. Bye-bye!